Good morning. Good morning. Welcome. We are now live streaming. My name is Cameron Burrow, Chair of the Finance and Expenditure Committee. You, Governor, are well exercised in these matters pertaining to Select Committee and your frequent visits after the monetary policy statement. Can I say you're looking a lot more relaxed and possibly a little happier than we've seen you in the past? And so we look forward to your introductory comments and to some exchanges here with the members. So welcome.
Wonderful. Kia ora ana tātou katoa, tēnā koutou katoa. Congratulations on your role as chair, and wonderful to meet new members, and always great to see, I won't say old members, experienced members. So I'm here today with Paul Conway, our Chief Economist, and Karen Silk, Assistant Governor, and I'll just make some really brief opening remarks. Chair, you were right. We are feeling more positive. Inflation expectations, measures of core inflation are all within our target range of 1% to 3%. In fact, very close to the midpoint, 2%. That is a very good position. That gave the Monetary Policy Committee, whose some members are here with me this morning, the confidence to continue to reduce the official cash rate by 50 basis points to 3.75%. We indicated we provide forward projections. We put all the usual conditionality around it, subject to the world evolving as anticipated, that we would have an official cash rate around 3% by the end of this calendar year, with further reductions front-loaded, really, kind of in the next couple of quarters. That's conditional on the activity going through there. In our projections, GDP growth is already picking up. It's not exactly going through the roof, but we have 2.5% GDP growth projected for this calendar year and next. Unemployment is broadly at its peak, but it is going to linger at these elevated levels for a little while. But the second half of this year, we see employment growth picking back up. It always lags the GDP growth, and unemployment beginning to decline. So that's a good position. What are we looking at? We're looking at, well, I'll come to the risks of why that could go wrong, but we're looking at, with inflation back in the band, spare capacity starting to reduce through the economy, touch wood, a period of reasonably stable nominal interest rates and inflation back within the target band. The exchange rate is broadly at fair value. Interest rates will be broadly around neutral. So that's where we've got to. Of course, there's plenty of unders and overs and risks. Probably the near-term risk is we are talking about turning points in the economic cycle. We believe that small positive GDP in the December quarter, picking up in the quarter we're currently sitting in, but turning points and, of course, GDP estimates highly fickle. In the medium term, some of the risks really are that once economic activity picks up, it could prove to be stronger than the benign level in a cyclical sense. Once people get their mojo back, business investment, employment, sometimes it can be stronger than that side. Likewise, we are sitting in a world of geo-economic fragmentation. So global potential growth will be lower, and we will see international price volatility. We're also seeing global interest rates edging up, in part around concerns around inflation, in part concerns around this fragmentation we're talking about, the risk, and in part around the levels of government borrowing in significant large parts of the world. So that's it. We're open for questions.
Okay, I'm going to go to the Honourable Barbara Evans first.
Kia ora ana katoa, Governor and Paul and Karen. So it is good news for homeowners, and it's good for those who are obviously in debt, particularly to the retail banks. But it's come at a high price, which is higher unemployment, record net migration, more company liquidations, fewer jobs available within the economy, growing homelessness, which we are starting to see a bit more, particularly through offices across the country, and arguably the deepest recession we've seen in New Zealand in the last 2 years, except for at the height of COVID. But looking forward in relation to tradable inflation, you noted in the MPS that some sectors are more sensitive to monetary policy and have declined quickly since 2023.
Mm.
But where it's more sticky is rates, insurance, energy prices, and you had some commentary around rates, rents as well. In the absence of fiscal policy to address this sort of sticky, non-tradable inflation, how fast can we expect the Reserve Bank easing cycle to have an impact on these areas?
Yes, thank you, and very well summarised. Yes, disinflation comes at a cost, but ongoing high and variable inflation comes at a permanent and far higher cost. So that's the challenge we've had is to get inflation down and as reasonable as possible. That's on the cost front. We target low and stable inflation, and it's great to be there. The good news, actually the interesting part is exactly what you're talking about. Now that we're in an environment of low and stable inflation, specific prices are really obvious and stick out. And, over the next few quarters, these official type taxes, the rates, etc., are a big component of total CPI inflation over the second half of this year. They're known, they're coming, that's why you see variability in our quarterly near-term projections. A lot of what you're talking about in part is who bears that cost, central government, local government, or the users. And so this is, it's kind of a shuffling of the chairs around who bears a cost that we know has to happen. I'm looking at the ex-mayor of Wellington who knows very much about the cost of trying to fix very glamorous and winning things like sewers and water. That is the challenge.
So looking now more so than it, so headline inflation still above what, because of some of those core segments. Looking now at tradable inflation, which we know was a significant contributor to inflation post-COVID, both domestically and internationally. This has eased considerably, but the NPS also says that it's expected to increase in the near term, mainly due to petrol prices, particularly with a weak New Zealand dollar, which I know is roughly around 6% down compared to the US dollar in the last year. You've talked about the fragmentation of advanced economies, particularly around tariffs, and Treasury, we've had Treasury in earlier, they've said it's too early to tell. And you've set out quite nicely in the NPS the factors that you are looking at in relation to that tariff war. However, what would be the likely impact on interest swap rates here, particularly for New Zealand banks, if US domestic inflation increases as a result of that tariff war, and if US interest rates don't come down?
Paul, did you address the...
So, like the first bit of your question is, sorry,
So what is the impact?
The non-tradable, sorry,
Yeah.
excuse me. Like tradables inflation is currently negative in an annual sense, which has been very helpful in terms of us achieving headline inflation, overall inflation, around 2%. And in a sense, it's kind of making up for the fact that we've still got significant domestic inflationary pressures in this economy. So in Q4 last year, domestic inflation, or what we call non-tradables inflation, was still 4.5%, but significantly offset by that negative inflation coming over the border. The thing about tradables inflation is it tends to be quite volatile. It does bounce around given energy prices, oil prices, the exchange rate, et cetera, et cetera. So we can't sort of depend on that being negative going forward, but it is giving us cover to lower interest rates with the confidence that domestic inflation pressures are going to continue to fall from high levels.
So what would be the impact then if, for example, inflation in the US increases?
And then the next bit of your question.
Rates here for New Zealand retail banks, given interest rates potentially won't come down if inflation's going up.
Like, it's like we are predicting that tradables inflation increases. That's, as you said, it's more about the exchange rate and energy. But as the trade war escalates, then the global economy, there will be more inflation out there and lower growth and a less efficient global economy, and that will spill over into New Zealand. Again, the Monetary Policy Committee, there's a few lines in the record of the meeting there saying, we can sort of see that brewing up. The best thing that we can do currently, because we don't have a handle on it really, on what those tariff shifts are going to be. So the best thing that we can do is have headline inflation at that 2%, so that we can sort of absorb that future volatility.
Yeah, I'll talk a bit about the global rates. So yes, if you see, there is a potential impact in the US of either higher or inflation levels remaining at that higher level, which means that US interest rates would remain higher. Now, they obviously have an impact on the longer term wholesale rates here in New Zealand, and that's part of the reason why we've seen that change in the shape of the interest rate yield curve. So higher interest rates in the US would lead to a retention of that higher rate sitting domestically here as well.
So it makes it hard. So
it will make it so swap rates would remain at these kind of levels, and that's part of the story that we've been talking about in terms of that transmission into mortgage rates and the longer term mortgage rates outside of increased competition remaining at around those kind of within the fives kind of level.
5% type levels.
Yeah.
And then the other factor in all of that is the exchange rate, because as we get differences in interest rates across countries, the exchange rate will adjust to that. So that's another factor.
Which is what we've started to see.
Yeah, and then that affects inflation as well. So you add that into the mix.
Thank you.
Just
to supplement.
Right, a sup from Dr. Megan Woods, and then a sup from Andy.
Mine was a sup actually on that.
Oh, was it? Okay, we'll go to Megan first, and then we're going to go to a primary from Ryan.
Okay, just to pick up on something that Barb asked about too, but I mean, I guess the thing is with the global economy, nobody knows. It's a wait and see. So you talked about what some of the kind of the things that you're watching, the indicators that you're setting out to watch. I mean, there's some people saying that actually a trade war could mean dumping of cheap goods in New Zealand, which
trade diversion.
Would lower prices in New Zealand. But what are the key indicators that as a Reserve Bank that you're looking at?
So, again, certainly for my mind, it's easy to think about the near term and then the medium term, the near term being, say, there is this outbreak and tariffs are actually raised as opposed to threatened. Then the immediate side is on what? For who? And that will determine very strongly around which prices are most impacted. But there will also be a more general story around uncertainty, in the immediate. It's already there. In fact, we've factored that some of that uncertainty into our projections. We've got a very dampened, subdued business investment projection ahead as people, globally, where do you put your factory? Who's going to be your supplier? Can you rely on your supply chains? These types of uncertainties. So that's the near term, and I agree. We can create scenarios where prices go up for our goods that we're exporting, and importing prices go down, and I can create the reverse story as well. So it's a matter of what and when and who. The more medium term and the unambiguous component is that global potential growth will be slower and demand for goods and services will be lower. And it's that medium term impact on New Zealand's GDP that we will not be able to escape. Higher relative price pressure, slower growth. Monetary policy will still do its job, but it'll be doing its job around an ever decreasing potential growth rate of the economy.
Okay, we're going to go to Andy Foster for a
Look, I just want to pick up a little bit on that exchange rate. Just our exposure to, as Barbara said, the exchange rate against the US has dropped significantly over the last 12, 18 months or so. It's just what the vulnerability of our economy is to that in terms of inflation. The proportion of our product that is imported, and therefore that exposure and how direct that is.
Yeah. So, the important thing to think about on the exchange rate is monetary policy can't manage really near-term shifts in relative prices. We just have to the extent we can, look through those, accept higher volatility in near-term CPI inflation as the exchange rate or prices move. But if we are credible and we are focused on the medium-term low stable inflation, then we should be able to look through those relative prices and they are less likely to become generalised inflation. So New Zealand, we can only control the price of our currency in our country, being domestic inflation. And so meanwhile, that relative price story, businesses, there's plenty of products out there, hedging options, forward contracts, so on and so
I was
forth.
talking more about the longer term trajectory rather than
On the longer
just
term,
short-term volatility.
On the longer term, an exchange rate is really just a nominal over a nominal. So, it's the price of beer in one country equaling the price of beer in another, having adjusted the exchange rate. It's a long-term underlying trend would be our relative productivity versus another country's productivity. That's the slow-moving component. So if you see, most of a change in the exchange rate is just the two prices, but underlying it is that productivity competition story. So that's, but that plays out over decades. And, we are a low productivity country relative to others. And so underlying that has been this steady decline in the real competitive exchange rate, lost in the noise of all of the other stuff I just mentioned.
Thank you.
Okay, I'm going to go to Ryan Hamilton.
Thanks, Chair. Thanks, Governor and team. I guess my question is a little bit more why you didn't take more of an aggressive position this time. I mean, this was the most well predicted, I guess, if you like, cut. And I qualify that by saying you talked about the volatility around the globe. Your next announcement doesn't come for 3 months. Our GDP is low, and as a comparator with Australia, their unemployment's lower, their GDP's higher, and their inflation's similar. So why didn't we take a more aggressive cut this time?
That's a really a great question. First and foremost, we can only focus on inflation and inflation over the medium term, the 1 to 2 years ahead, given how long it takes to happen. And we're very pleased with where inflation has come. And thank you for saying it was well signalled, because we've been very transparent around where we see it happening. On the more aggressive cut, as the Chief Economist just mentioned, we are still seeing high domestic core inflation, and that's the bit that monetary policy really bites on. 4.5% of percent is the non-tradable inflation rate as of December. Better measures of core inflation have it around 3%. So that's still elevated relative to the midpoint of our inflation target. We're confident that's going to go because of the spare capacity in the economy. So we're going to be in a position where economic growth is picking up, spare capacity is declining, employment is picking up, but inflation will continue, core inflation will continue to decline. But we need to be a little bit cautious. If I was in front of this committee a year ago and said we're cutting by 50 basis points and core inflation was at 4.5%, the committee would say, you're not credible, you're not focused on the inflation story. That's the balancing act. It's not 3 months, we're back in, when are we back? 6 weeks. 6 weeks.
6 weeks.
Yeah, so there's a couple of 6 weeks. We're talking about the OCR potentially being 50 basis points lower by the mid this year. These are all different shades of neutral. We are and have been probably one of the most, I don't even like the word actually, the word you said, we've been one of the most aggressive central banks in our cutting and delivering. Australia at the moment, they cut by 25 basis points, and the media is all about how hawkish they are, not how wonderfully fast they're being. They've said, look, here's a cut, but we're not sure we can do any more.
And the reason for that is, headline inflation might look relatively close to where we're at. Their core inflation's closer to 4%, not 3%. So they've still got a long way to go to bring that back into that close to 2% level. So they've got a long way to go on that. And when you think about where they are in the cycle, and you look at the consensus forecast moving forward, their growth rate over 25 will be less than New Zealand's.
And can I add, we've already done 175 basis points in a little over 6 months. So it's not exactly like we've been sitting on our hands. And the committee's, comfortable that that is consistent with inflation near the midpoint of our target band, as it has been the last couple of quarters.
Just a quick sup from me on that. You used to have 8 OCR announcements up until 2015, and then there was one of 9 in 2020, and we've been sitting on 7. We haven't had an OCR announcement since MPS since the 27th of November. We always used to have them in January and most often in December. Is there the consideration that you would bring back 8 OCR announcements so we could see more relief for the likes of homeowners in January rather than wait till February?
So, yes, the committee is discussing timing. Excuse me. I'm not gagging on the question, just gagging at the idea of having to do 8 meetings. No, we'll revisit all of the timing around that. I will say, and it's wonderful, if you think back to the opening remarks, Mr. Hamilton just mentioned, that this 50 basis point was incredibly well signalled, it was delivered. In other words, it was already in the financial market pricing. The actual interest rates did not miss the fact that Mr. Orr and co weren't smiling at you in January. There was the forward forecasts that we put out were taken as convincing, and market pricing, didn't move yesterday. With our 50 point. It was already priced.
It was already built in.
If it was
to
a high dive.
wholesale and into a number of the retail rates as well.
I will note cheekily that more meetings to achieve the same thing is not a definition of productivity.
I should clarify, I didn't mean to give you as much credit for the signalling, so I was signalling.
Yeah,
Market responds to their signalling.
And a real challenge, on a serious note, a real challenge of us constantly telling where they should be means that market pricing and forward pricing is giving us no information. It's just us looking in a mirror saying, wow, isn't the market so clever they've expected what we just told them. It used to be called the Greenspan put in markets. He spent so much time trying not to spook the markets that he ended up watching himself in a mirror. There was no forward information coming about how the economy was evolving. So not meeting market pricing isn't our objective. Low and stable inflation is.
And I see you don't travel with a briefcase, so we can't see if it's full or empty like Mr. Greenspan. Dan Bidwell.
Thank you, Mr. Chair. This is kind of like what my colleague Ryan was talking about, but modelling, because I think while the Reserve Bank has been aggressive, the bank has been criticised in the past for being too slow to react at the start. For example, 2021, your MPS in 2021 had inflation at 3.7 for 2022. It was 7.1 for 2023. It was 2.2.
We know that's true.
Yeah. So, and again in 2024, looking at your August MPS, your forecast OCR reductions were in the 0.25 range. So I'm really keen. It goes to the heart of your decisions have real life consequences in terms of unemployment. A slowdown in economic activity.
So the question is,
what changes has the bank made to ensure that your forecasts are more accurate so that this doesn't happen again? Because there are uncertainty.
Okay, so what changes? Yeah. Yes. So I'd love to refer the committee to an internationally reviewed, transparent review of everything we went through that particular period of history. It's note RAFM, and we're one of the few central banks globally that stood up and did that. All of the answers are in that report. We found 7 things we could do better and work on. I'm not going to repeat those because it's there for all to see. We were one of the first central banks in the world to be tightening. We're one of the first central banks in the world to be easing. So, that doesn't mean that's good. 3 forms of uncertainty exist. The first one is, where are we today? Where are we starting from? In New Zealand, our GDP figures were just recently revised back over 3 years. In fact, the recessions that we were being blamed for have been revised away.
We were blamed for them. We were blamed.
We did a good blame storming around this table. So, the starting point around GDP, we have to make very bold and calculated decisions around where we're starting from. With that huge volatility and lag in official data. The second uncertainty is, how does the economy actually work? That's not just the domestic, but global and then monetary policy. That is around our forecasting frameworks. All models are wrong, some are useful. And then the third shock, which is the unknown, which is the one that is mostly explaining what you're talking about, is stuff happens, unanticipated events around which we just have to weather. Monetary policy is not going to save New Zealand from trade barriers. Monetary policy will not save people from global shutdowns. You know, we just need to stay focused on what cards we can play in the balance of risks. During that period you talked about, and I love the day when we can move on from it, by the way. During that period we talked about, that will go down as one of the most significant economic stories of hundreds of years. And yet we managed to get through with inflation peaking at only 7% to be back where we are now, and unemployment around 5.2%. Probably you go through the 1930s shocks, hyperinflation, depressions, recessions. So yes, we can always do better. Yes, the research team are trying to do well within our limited budgets and timeframes, but the world is uncertain.
Thank you.
Can I just add to that?
Yeah,
I can't,
thank you.
like there's nothing we can do about shock uncertainty. I think there'll always be economic shocks. Absolutely. That's just half of the course. But in terms of starting point uncertainty that the governor referred to, and in terms of that economic uncertainty, that sort of model uncertainty, understanding the economy, you know, this is exactly why, and this did come out of RAFIM, this is why we're doing more research now, you know, we're doing more work on our models, because we can mitigate those sources of uncertainty. And if we get that right, you know, then the monetary policy will be more optimal. So we can.
Mentioned your conference coming up.
Well, yeah, I mean, we've got the Reserve Bank hasn't had a conference for 5 years because of COVID and all of that. But prior to that, we used to have a conference every 2 years just to make sure that our research and our modelling thinking is at that global frontier. And we've actually got a conference coming up in a couple of weeks on the 6th and 7th of March, where some academics and people from globally are coming to New Zealand and to talk about inflation targeting. We've got Ben Bernanke, Nobel Prize winner in economics, coming. We've got Dr. Catherine Mann, used to be chief economist at the OECD, currently a Bank of England MPC member. And again, the purpose for that is just to continually keep polishing our understanding of how the economy works and get on top of the data so that we can understand that starting point, so that we can reduce the chances of
Thank you.
error.
If I can just follow up. So yes, I read the paper, and
Good.
I'll move on from that to the August NPS from last year, which has quite different forecasts on GDP, CPI, and OCR reductions. So my question is, even within the last 6 months, our forecasts have been off pace. And so
I think that's an incorrect statement, what you're saying. We have been probably almost bang on with the inflation and what we need to do with the OCR. And I'm happy to come back. What you are probably referring to, I assume, is the May monetary policy statement back last year. In the May monetary policy statement, we were talking about domestic inflation being unusually sticky. You know, it was still at over 5%. It was
Widespread.
and widespread, you know, the slow moving part of it. And we couldn't really explain it through our models, our frameworks. What we've since discovered is that it was because GDP was being mismeasured. It has had, what, a 2% shift in over a 2% revision in the level of economic activity in this country.
I mean, I do have the August NPS here, and you're explaining it as revisions in GDP forecast from Stats New Zealand. Is that right? Or?
Yeah, in part.
Okay, we're going to go on next one. Dr. Deborah Russell.
Thank you. It's really an interesting exchange we've just had. Look, that understanding of the economy, because I picked up on it in a number of places, where you said that labour productivity wasn't as weak as you had previously thought, and all those sorts of things, which is, you know, I get that the measurement is difficult. I'm just concerned, there's a couple of things there. One is the ongoing revisions to GDP. That's coming through from Stats New Zealand, is it?
Yes.
Yeah, so we've got, you know, I know they work their hardest too. There's no one there who, they want to get it right.
Very sharp, very proud institution.
Yeah, and I know, so I don't want to cast aspersions on them at all. Do we simply need to pile some more funding in to ensure that we can measure inflation more,
Yes.
measure GDP? Yep, okay.
And
Not
CPI.
just-
And inflation, monthly would be great
Yeah, I
instead
know.
of quarterly.
All right, so.
We have a list.
Paul's, I mean,
Okay,
And we're in a queue.
for fear of this turning into a budget pitch, Deborah.
we can't
The wrong
expect,
institution.
we can't expect you to do your job well if we can't do the job well of
The
supplying the
data that
data.
you
that
use.
We are in a queue for Stats New Zealand data, and they are prioritising as best they can.
Yeah,
And so-
no.
What we have to, the consequences for us is we have to increasingly rely on high frequency indicators that are naturally volatile. So if you start thinking about your August comment, we're trying to build a picture of data that is mismeasured
And 6 months old.
and 6 months old and highly volatile, high frequency indicators at a turning point in the cycle. So being completely accurate around the research teams and the forecasting teams being completely accurate is impossible in that scenario. What they have got right is the trend. And
Yeah.
that is important for us when we think about inflation, because we are thinking about it across a medium term. So the trend is just as important as the level.
Trend is your
Okay, I've
friend.
got a sup from Dr. Megan
Have you,
Woods.
no, I think Tim
I-
hasn't finished.
Oh,
yet.
I did want, you go into your one.
I just want to pick up on your queue
Sorry.
at Stats New Zealand for data, that you're in a queue waiting for that data, and you've sort of said that it's 6 months old. In terms of you being able to produce more accurate forecasts, what is the lag you'd like to see in the data that you're working with?
Well, if I'll go to standard OECD capabilities, that would be monthly GDPs, 3 ways of measuring it: spending, production, and income. So you can triangulate the way it goes. Monthly CPIs that are important. We keep talking about the frequency, but also the rebasing of it. I mean, our consumer price index hasn't been rebased, i.e. are these weights still the right weights to have on each consumer product? And what we're measuring within those weights, are they right? I mean, I use a simple example, a laptop is always costs $2,000, but what you get in that laptop has changed beyond belief. And so, it's called hedonic pricing. What is a laptop is not a laptop. It's, it's moving all of the time. So you need to rebase these things on a pretty regular frequency, and that has just been put in the back drawer.
So
too
have
hard.
you talked to government, to ministers, about the need for better access to data?
Yes,
from
yes,
Stats
we
New
have.
Zealand,
I
and
mean,
more frequent?
Yes, I mean, I was faced heavy questioning from the Prime Minister and Minister of Finance about exactly these issues, and I had to remind them we're not the Stats Department. We are working very closely with the Stats Department. We lift and help. We are a significant provider ourselves of data and information. So we try and work hand in hand with them, and we have found means and ways of achieving what we've done, building on just smart, high-frequency data. Yeah.
Okay, Deborah, we'll carry on then. Close Warwick's being very patient there. You're after Deborah.
So there's a whole set of stuff which I'm really interested in around the workforce, and as a Labour MP, of course, we're concerned about unemployment and all those sorts of things. But there's a bit of a hidden story that I can't quite get at, which is the impact of migration out of New Zealand. So we know that net migration is slowing. One of the ways we've propped up the economy many times is over immigration. So we're losing people. And there's a whole interplay there. Is our unemployment rate only staying low because some of it's being exported to Australia?
Yep.
Okay. So that's kind of worrying. But then in that context as well, you're saying that if I'm, let's see if that's page right, you say that unemployment, here I've got on page 24, that it says labour market conditions have remained robust. This is the global economy, and that in our most advanced economies, unemployment rates are relatively low. How are we stacking up against other economies in terms of unemployment rates?
Yeah, there's a
It's a complex story.
Oh, absolutely, absolutely. And your point on migration is well made. Like people leaving, particularly for Australia, where the labour market is in a different place, is part of the reason why unemployment isn't a little bit higher here. We've also had people leaving the labour force, so participation rates are down as well. But in terms of unemployment, I mean, you can see it in figure 3.3 on the page you were referring to. So our unemployment rate is, 5.1%. It's kind of middle of the pack.
Across countries,
Yeah.
Canada, Europe, US, Australia, etc. So it's a global phenomenon. As you slow an economy down, part of that is meaning less demand for goods and services, and then employment and unemployment, has picked up, but relative to historical averages, it's still pretty low in New Zealand, not particularly different.
Yeah.
But we do have that, what you say, that release valve, the ability
Yeah,
to be
change
shifting
movement.
backwards and forwards. The number one explanatory variable of New Zealanders, not as far as going backwards and forwards between Australia, is just relative GDP growth. It's been something that's gone on forever that, we
I know, we're the reserve pool of labour, they're our,
we don't really get many Australian, but then total migration also has the inflow. So we have kind of new migration. You have some sense of control over new migrants coming in, but we can't stop Kiwis leaving, and so it's an unpredictable variable.
Okay.
so there's just.
Right, well,
other
last one,
factor
'cause I'm gonna get-
that- So, I mean, one of the things that's interesting is that, as far as I can see from the figures, that business investment isn't really pick up until about 2027, I think, or maybe 2026. I do, just got one of your staff.
It's a bit earlier, but yeah.
It's a
but
bit
I mean,
earlier, later this year.
That's the worrying bit, because we often hear a narrative about labour productivity being low in this country, but I'm worried about the extent to which.
You're spot on. If it was a single variable in there to worry about, it's the lack of investment, business investment. That is the key to innovation, productivity, and hence potential growth. Business and the government investment, so we're kind of doing the standoff at the moment. Who's going to pay for this, that, and the other? We talked about rates versus taxes versus central government, and all those things. The investment has to happen, and we have an infrastructure deficit, and we have a very capital shallow country.
That's it.
Particularly the business sector. We love our dividends. We love paying out any returns. We don't like firms reinvesting in themselves. We want the cash. That has to fundamentally change for us to lift long-term productivity.
Okay, we're certainly seeing some encouraging signs on business confidence and farmer confidence, aren't we? Okay, we're going to go to our Greens member, Chloe Swarbrook.
Morena koutou. Speaking to particularly those trends and the forecasting there, trend labour productivity. So you've got a table on page 51, table 6.5, which shows that since 2024, we've got the lowest as far back as you go to 2018 on that page in terms of year-on-year trend labour productivity, and you're forecasting out continued very dismal figures. Could you explain that picture for us, both the actuals and what's driving your projections for that very low, very dismal trend labour productivity?
Sure. Part of that is the weak investment that we were just talking about. Like that's this capital shallow. Being capital shallow is a huge part of New Zealand's productivity issues. The other thing about labour productivity, yes, the GDP revisions increased GDP, so that did improve labour productivity, but nothing to get excited about. It went from kind of abysmal to merely awful or disappointing. So it was still negative, actually, labour productivity growth over the past few years. And a big part of our very, very weak sort of forward projection for productivity is just the fact of where we've come from. Labour productivity, it's not really a high frequency thing that bounces around a lot. So the recent past is as good a predictor of the near term future as you'll get.
And the way in which we can explain it is you can kind of account for GDP growth by how many people or how many tools or capital went in. And then what's left over is how innovative or productive we were using the people and the equipment. So it's the kind of residual in that sense explaining. And most of our GDP growth has been by adding more people.
And if I may just further interrogate that point, because, you know, that turning point is the 2024 actual figure. And there we have seen intentional fiscal policy to crunch the size of government spending quite substantially. And we haven't seen, and in fact, you guys are saying in your own report, I believe on page 24 or so, about how you're not expecting private investment to fill that gap. So I guess, could you just explain what that means in real terms to the folks who may be following along at home? You've got the government contracting its spending, and then you're seeing, or you're not going to see the private sector filling that gap. What that means is that we're seeing less of that capital, less of that investment, and therefore less productivity and less of that growth that is ostensibly the goal of the government.
Yeah, I think the important part is to take near-term measures of productivity are highly influenced by just volatility in GDP, the numerator going on. So you have to step back and take a longer-term view on it. And, you know, we are in violent agreement here that in the absence of sustained investment that is producing, you know, that's wiping its own face, achieving returns, you will not see productivity shift in any meaningful way in this country. So, you know. Yeah.
I mean, if I may on that point, obviously you guys have many times over articulated that monetary policy, and obviously the OCR is an incredibly blunt instrument. What is it that the Reserve Bank can do here? Or are you kind of just saying that this is the limitations of what you are able to do in fiscal policy, i.e. the government needs to fill the gap?
It's the limitation with regard to monetary policy. Monetary policy is only one of the things the central bank does. And so we have a significant list of work and broader activity within the economy aimed at competition, efficiency, productivity, sustainability. In fact, our statement of intent has these key strategic themes in there. What are some of the things that I would really love people to listen to better rather than worry about capital rates? It's around what is efficiency, what is productivity. If you think of all the efforts we're trying to make at the moment, we're trying to make the same horse go faster. That's productive efficiency, cutting costs, arguing about the same banks, how they could do this, that or the other. The next one is allocated efficiency. We're spending enormous hours around this table, FECs, around whether farmers do or don't get a better deal than someone else or not. Around it, that's allocated efficiency. You can change that. All you want is hardly going to shift the dial on actual productivity. What is that? That is dynamic efficiency, not doing the same thing better, but doing better things. We are working very closely around central bank digital currencies, around open access to ESAS and payment and settlement systems. We need to have investment in those areas. They will fundamentally change this society. The government will be able to directly transact with individuals. You will be disintermediating transactional banking services that are one of the most expensive in the world. Banks are allocating capital. Banks are making most of their money at the moment just on transactional. And we need to wake up to that. By the way, I'm saying this on very strong ground. We've had research papers and speeches and whatever forever, but all we ever get asked about is bank capital.
Okay, we're just in the closing 5 minutes here. I'm going to have, there's two that haven't had primary questions that have signalled early on. That's Nancy Liu and Dr. Megan Wood. So I'm going to go to Nancy first and then you, Megan.
Thank you. And to have waited so long, most of my primary questions have been asked, which is great. So I'm going to ask us actually on the central bank digital currency you talked about. So you're talking about what disruptive will be, you're talking about how the changes that will bring to productivity in New Zealand and in the market.
Yep.
So when are we going to see that coming?
Oh, well,
what is the incentive for people to come on to it?
You are the owners of that. We need significant government decisions on digital identification. We need support and investment in the development of the central bank digital currency. We could have something like that by 2030. And we're already moving on significant areas, and we're very public and transparent about it. $5 million to come and open a bank. The open access to ESAS, all of this stuff is consulting. It's all there. So we've taken the horse to the water.
And in your opinion, then, how do we bring it forward to earlier than 2020?
It gets
And how we
on
can
the
get-
attention of the government around what we can do to shift the dial. We've got a big menu and we're already working very well on it. It needs to be picked up. Cross-government, Council of Financial Regulators, we're working very clearly with them. We've had meetings with MSD, IRD, DIA, all of these departments. We're very nervous that they've all got their own budgets to build their own technology, but they know that we could have the central and do that. At the moment, the incumbents are in charge of their future. Payments New Zealand, which is owned by the banks, are in no rush to disrupt their own income stream. There's plans to have plans, but those plans have been there as long as Karen and I have been involved in banking.
Yeah, yeah. It's
Okay.
been talked
So
about.
just one last up then, which other countries can we look into?
I would look at India, Malaysia, Singapore,
Brazil.
Brazil. I would go onto the BIS website and look at the innovation hubs. That's the Bank of
We are
International.
the only OECD country that does not have fast payments.
Okay, we've just got a sub off there from.
Thanks, Governor. Quick start, because you did mention the ESAS, and Minister of Finance did write a letter of intention to you, I think, in
Yep.
December,
Yep.
talking about opening up access to ESAS with rules coming out, or your decisions coming
Yep.
out next month. Can you give us a quick and dirty on how that's shaping up?
Yes, so we will be taking a paper to our board for approval in March, and with hoping to do the first phase of delivery and market in April. That will expand, the intention is that will expand access to a much broader suite of entities, including non-bank payment service providers. There are obviously conditions that they will have to meet. This is a very important system. It is the foundation of
New Zealand's financial
New
system.
Zealand's payment system. So we cannot do it in a way that creates unnecessary risk to that, but the non-bank payment service providers will have access to that as part of that.
Dr. Megan Woods.
Thank you. And in the last 3 minutes, previous monetary policy statements over recent times have had quite an emphasis on the housing market. I think one of the features of this is that housing doesn't feature nearly as much.
Exciting, huh? That's
No.
good.
But what we have heard, going back to Barb's first question, is that kind of one of the costs that we're seeing at the moment is increased homelessness. And the kind of affordability of housing for a section of society. So in terms of the analysis that you're doing around the housing market, access, those things, can you give us the 1 minute overview?
So really quickly, the first thing is nominal house prices have come back significantly, but they came back from an extremely overinflated situation. Looking forward, we now have our deposit, DTI, what's the acronym?
Debt to income.
Debt to income seatbelt, which means that people will have plenty of room to move, but they aren't going to get shoved through the windscreen if the market crashes, as per last time. Our loan to value ratio, and we are talking about interest rates even at 3%. The retail interest rate is still going to be around neutral, 5 something. It's not something that's going to set the place on fire again. So, belts and braces, but what's the famous saying? There's not so queer as folk. They love housing in this country.
Love something.
Well, if they bought a house for a dwelling, that would be wonderful.
Thank you, Megan. Governor, just finally, how if you were to sum it up, how should New Zealanders be feeling as we go into 2025? Given your announcements and statements over the last 24 hours.
That there is light ahead, and it's not an oncoming train. It is positive GDP growth, employment growth coming through, and low and stable inflation. So I would really hope that the central bank disappears off the screen. It's back at stable.
Back to stable. Thank you very much.
Thank
Thank you to all
Cheers.
your officials and stuff. Thank you. Thanks for your time.